Hi, Steve Bolduc with the Bella Group. Welcome to my weekly real estate market update. Today is July 29th. It's the last Friday of the month. And we're going to talk about the big news from Wednesday, which was the Fed increasing the Fed funds rate by 75 basis points and interest rates going down. That's an interesting little twist there. So getting into it right now, YouTube algorithm, please click the like button, subscribe, and ring the notification bell so that you're getting notification when new content comes out every week. And throw some comments in there if you have any questions, if you disagree with anything that I said. I look forward to hearing from you, learning from you as much as hopefully you're learning from me. On the market today, 6,560 houses, which is barely up from the 6,512 we had last week, so pretty flat. About 35% of the houses out there still are houses that have been on the market for greater than 50 days. Got some kind of distress issue related to it. Could be cosmetic, could be something else. Great opportunity to do a renovation loan and get that HGTV experience that you're really looking for and be able to control it and really make it your house. I've done several of these. I know lenders that are very good at this, and I have contractors that can help you out all the way through the process. Demand. 54,000 homes were sold last year. Right, the first half of 2022, we sold 21,000. So if you just double that, we'll be at 42. Historically, the second half of the year, we sell more homes. So I'm thinking we're probably going to be closer to 50, but let's use the 42 as a conservative demand amount, lower amount, right? So we went from 54 to 42,000 homes sold in a year. 42,000 homes sold in a year is 3,500 per month. With the 6,560 houses active on the market, divided by 3,500, we have 1.9 months of inventory on the shelf. We like to have 6 months. So even though demand has come down, supply is still so low that we are still a very strong seller's market. And until we see a change in the market dynamic, we're going to continue there. Now, buyers are more particular. They're not buying up anything at way above asking prices. The nice, ready to move in houses are still selling quickly, multiple offers at or above asking, but anything else is not selling like that. So there is definitely a change in the dynamic of the market. So let's jump into the real meat of it, which is the Fed funds rate being increased by 75 basis points on Wednesday at the Fed meeting, and then interest rates going down. So there's a couple articles here. The first one talks about the Fed doesn't actually cut or increase the mortgage rates. It changes the Fed funds rate, which is the rate that banks charge each other for overnight loans. And then that filters through the financial system to get to mortgage interest rates. The article very quickly describes that. It's a quick read, few minutes, and it's not very technical, but at least gives you a general idea. The second article, which talks about how to explain the huge drop in mortgage rates this week, that goes into a little bit more detail as to how the Fed funds rate translates over to mortgages. But so both of them are good reads. And if you're interested to know how that works, I do recommend checking them out. The TLDR is the markets price these events in. So members of the Fed give speeches all the time. And they talk about what they see happening in the economy and what they think the financial and fiscal policy should be. And the market figures out from that what the most likely outcome of the next meeting is going to be. And they price that into the market even before. They don't wait for the announcement. They've already kind of guessed. When the Fed surprises, either good or bad, then the market reacts. But if the Fed does what the market expected, then the market's happy and everything kind of stays steady. So in this particular case, the Fed did exactly what was expected by having that 75 basis point increase in the Fed funds rate, but they changed their tune a little bit when it comes to what they're telling people to expect going forward. They're talking about a more dovish or lower interest rate increases response going forward because they think inflation is behind us. They think June was the peak and we're going to start coming down. Now, the next inflation report at the end of in August for July will give us a good idea what's going on. But that's what the Fed thinks right now. So because of that slight change, interest rates are starting to come back down. The market is starting to price in that new expectation of the Fed not raising interest rates as much as we thought they were going to be before. So that's a big part of the reason why interest rates are coming down. Another thing, mortgage rates track the 10-year treasury. So if you look at the 10-year treasury yield, and this chart shows it, the gray is the 10-year treasury yield, the orange is mortgage rates over the last, I don't know, it's 20 years or something like that. This, you can see that the ups and downs are pretty much aligned. There is a gap between them, and that average over time, that gap is 1.7%. Right now, we're at about 2.5%. So interest rates are 2.5% higher, round numbers, than the 10-year treasury yield. And the average is usually 1.7. So I expect that yield, that spread, to close up closer to the 1.7 over time. And I think that's what we're starting to see happen right now. Now, as long as the Fed keeps doing what they have said they're going to do over the next few meetings, which the next meeting is not until September, but when the September meeting comes, as long as they continue to do that, we should see mortgage rates stabilize, come down, stabilize, maybe in the low fives, high fours. Now, black swan events. What could happen that could blow this whole thing up? So I came up with 3. There's probably more. Throw some in the comments if you can think of anything else. The first one is an inflation spike, right? So the Fed thinks inflation's behind us. Well, if inflation comes roaring back, the Fed's going to have to change their tune. They're going to have to say, well, we said last time we're going to be more dovish. Now we need to be more hawkish. We need to be more aggressive. That could potentially change the mortgage rates and impact the real estate market, because it will drive demand down even further, which is something that has been slowing the market down. Now, what else could happen? Well, we're in the earnings season right now. Some companies are reporting very good earnings, some not so much. It's been a mixed bag. If you get too many companies that have issues with their earnings, you could get to the point where they start laying off employees. So with inflation, consumers have pulled back significantly. If people start getting laid off, that's going to drive demand in general, and certainly demand within the real estate market, down even more. Not only that, but if people start getting laid off, they may need to sell their home because they can't afford it anymore. So maybe they list their home for sale. So supply comes up, demand comes down. That could cause a significant shift in the dynamics of the real estate market. The final thing is monkeypox. Hopefully this is not going to happen, but it has been speculated. I heard a few people say stuff. If we have a COVID-like response to monkeypox where we shut down the economy, we already know what happens when you shut down the economy for an extended period of time. It's pretty catastrophic. So hopefully monkeypox is not a big deal. We get through it, and we don't have to worry about that, but that is another black swan event that could cause an issue for us. So that's kind of what I'm seeing right now from a real estate market perspective, and the impact that interest rates are having on it. The primary mortgage market survey, as I said, it was 5.3%. I saw a reading today, 5.22. So it's continuing to come down from that peak of about 5.8. And we talked about the details around that. The last thing I want to wrap up with, over the last 50 odd years since 1970, we've seen a pretty wide range of interest rates. We're coming off of historic lows. But if you go back to October of 1981, we had 18.44% interest rate. That's over 3.5 times what our interest rate is right now. Although it's not as great as it was recently, it's still not a bad interest rate. And we just got to keep that in mind as we move forward. If it's the right time for you to buy, if it's the right time for you to sell, give me a call. We'll talk about it. We can definitely make it happen. I got 3 closings happening this week. So it's still happening. People are buying and selling houses. So hopefully you got some value out of this. If you did, like I said, please click the like button. And I hope you guys have a great weekend, and we'll see you again next week. Have a great day.